Good morning, investors. Welcome to the December 18th webinar presented by Portfolio Builder. Folks, my name is Dean Gallagher. I'm an investment consultant and partner. Want to welcome you in. Thank you very much for taking the time to join us here live. And if you are on the recorded version, appreciate your time to join us as well. All right, guys. So let's go ahead and jump in, take a look at our portfolio structure real quick. We're quickly taking a look at the Safe Alpha portfolio structure. Okay, and as many of you guys have seen the past few days, we took some time to show clients how easy it was, how easy it is, and how easy it was to take literally a minute to get this portfolio structure built out. So let's cover these trades real quick. Okay, so first is our TQQQ ETF. That is all of the top tech companies on the planet. Just like Warren Buffett's top position, we do have a massive exposure to Apple, and we have some leverage with that massive exposure to Apple, which is wonderful. Okay. On top of that, we have Amazon, Microsoft, right? Google, Facebook. The people that really control the technical monopolies of the planet that have never been seen in human history before. And folks, if you can't join them, or if you can't beat them, join them. Okay, so that position, folks, since we entered on 11/24 on the TQQQ ETF, we entered at $1.4798. Today it's at 175.31 and pulled back just a hair here, which has been nice because that we've had 2 days this month that it's pulled back. This is one of those days, so beautiful day to get built out. The total portfolio profit on that position is $109,112. Okay, let's take a look at our next position. This is going to be our value play, guys. Okay, this is going to be our shortest term play in ERX. Okay, so this one's going to be a little bit faster. Our TQQQ, literally, we're never going to sell it. Okay, and for me, you're going to have to pry it from my cold dead hands before I let go of it. Okay, so next, guys, is our ERX position. That is our value play here in the oil and gas companies. These are the best oil and gas companies that there are, the largest ones, and they're at a 30-year price location discount. So wonderful advantage, a wonderful opportunity to take advantage of that value play there. Okay, and that should be the shortest time frame position that we have, but we're looking for a massive run up in a shorter period of time. Okay, next is our AGQ position, folks. This is kind of dual prong. Okay, now this will hedge, okay, against our technology position. This will also hedge against our oil and gas position. This will also hedge, okay, against the dropping cost of our savings. Look, all of us, and I don't care what country you are in the world right now, all of our savings are diminishing by the day. Okay, the value of cash in the United States has dropped by at least 10% this year. If you're in big cities on the coast, you're looking at closer to 13, maybe even 14%. Okay, but the best way to protect against the dropping cash value, folks, is by owning silver. Now, we have some leverage into silver because guess what? The Fed is leveraging how much money they're printing right now. And if you look back at 2009, they printed about $1 trillion. Well, we've already printed 3.6 trillion this year. Okay, estimates for next year is going to be another print at 3.5 million plus a stimulus deal that could probably end up somewhere between $1 and $3 trillion. So not hard to understand that you want to own that ETF. You want to front run the stimulus that is coming. You want to also front run the next $3.5 trillion QE print in 2021. Okay, so these two trades, folks, are going to be our alphas. Okay, for really the short term. This is our long-term alpha. Okay, and really, guys, this is our insurance policy. Okay, so this is what helps us sleep like babies at night. Because if the market goes crumbling down, guys, this ETF is going to go skyrocketing up. Okay. So UVXY is that position, and it is showing a drag to the portfolio performance, which is totally okay. Okay, and that is there, guys, just in case there's the disaster, right? So long-term hedge, we don't really want to sell. Short-term alpha, okay, really something we'll probably own in the shortest time frame. AGQ, wonderful way to hedge against your TQQ, your ERX positions both, and also at the same time protect yourself against whatever you have in your savings that's devaluing. Okay, and then once again, we have our insurance policy here with UVXY. And so as you can see there from the build out on 11/24 to today, which is exactly 3 weeks, we are up $111,000 since that time. So just real quick, guys, we're going to do a quick introduction. Then I'm going to hand it over to Jason. We're going to help you guys understand what the financial system looks like. We're going to show you the big picture, guys. Look, there's few people that control the markets. We're going to teach you about that today. Okay. So thank you, folks, for the quick introduction. So next, guys, we're going to take a look at what 25% can do. 25% a year can do for your money. Compounding is fun. Okay. Look, Warren Buffett is the master of compounding. Okay. We're going to show you how to build out a portfolio structure that's very similar, but we're going to use some leverage because quantitative easing is in place. Now, number 3, guys, we're going to look at risk parity investing. Okay. You're going to learn the billionaire system today. Literally, there's not a billionaire on the planet that's day trading, that's swing trading, that's option trading. Okay. What they are doing is they're getting the best assets on the planet and they're hedging the risk. Okay. And look, if you've ever studied Buffett, okay, he's looking at 10-year time frames, okay, at minimum. So we're going to show you guys how to do that with your core position today as well. Okay. And let compounding do the work for you. Now, number 4, we're going to have the Q&A for attendees so you can ask questions live with us. Okay, the most fun part of the presentation, guys, we're going to do live portfolio buildouts with the group here. You know, as I was talking with someone yesterday that was up $23,000 from their portfolio buildout from last week to this week, used a decent amount of capital. Guy's super happy as one of our clients at this point. Okay. Now, guys, number 6, we're going to look at the danger of cash and why any dollar, any fiat currency is trash. Okay. And we'll cover that. Last, guys, we're going to look at the holiday bonuses. Okay. We have all of our portfolios 50% off at this point in time for the holiday special. Okay. We are going to revert back to normal pricing next week. So make sure to get signed up today. Okay. And then, guys, just if you have any questions, I'm going to give you my number. It's 505-322-7515. That's my cell, guys. You can text me or call me at that number at any point if you have any questions before you get started. Okay. Happy to look at your investment ecosystem, see what things look like, see where you may be overweight, where you might be underweight, see what your cash fire looks like, and do my best to help you get in the best portfolio possible. Okay, so let's look at the power of compounding, guys, and it's a bit different today. And I love this quote. This is one of my favorites, actually, of all time. Compound interest is the 8th wonder of the world. Okay, now in today's world, guys, you know, the interest products are garbage, right? 2% is not going to stave off, you know, a real devaluation of our currency at 10% in the States on average. You know, can be higher, obviously, and you know, Lord forbid you're in a country that you're looking at 20%, and there's plenty of those. Okay, and who knows, the U.S. could be in that boat next year. Okay, so the power of compounding starting with $100,000 now. So below are the compounding returns achieved from investing $100,000 at 25% rate of return for 20 years. Okay, so Warren Buffett wrote a beautiful book called Snowball. If you haven't read it, you should. And this is going to show you how your money will snowball. Okay, so this is the return year 1. You see how this starts snowballing down. And by year 10, guys, it gets crazy. You're then making $186,000 a year in growth of your capital. That's more than 98% of the households in the world make. Okay. And then you may notice down here at year 10, you've put a 9x multiple on your money within a decade. Pretty neat. Okay. So let's look at years 11 through 20 compounding gains with our help. Okay. Let's get this snowball, get some serious momentum. Okay. Look at this, guys. At year 15, your money's growing at $568K a year. Year 20, it's growing at $1.7 million a year. Okay. And if you look over here, well, you've now put a massive 86 multiple on your money. Okay. Over the span of 20 years. And for a lot of people, that can be retirement. Okay. And just let your money work for you for the rest of your life. So kind of fun to see what 25% a year looks like over 20 years, right? Now, the average return on the S&P 500 is currently 10%. So you need a better strategy than to simply owning the S&P 500 to achieve this. And it's funny, I was just talking with John earlier today, the average financial advisor, right? They keep saying 7% is going to get it done. Get out of here. That's not even going to compensate for how much you're losing in monetary value of your money every year. So the whole 7%, guys, with the advisors, throw that out. It does not work. Okay. So we're here to help. with the creation of ETFs, this is made incredibly simple and safe. There's literally an ETF that you can own to position into all big, unstoppable trends. We're here to make sure you have the right assets during your journey. Now, let's take a look at why Portfolio Builder is different than the advisors, the mutual funds, the hedge funds that we compete against. Okay. You'll have major advantages over the traditional advisors, mutual funds, and hedge funds working with Portfolio Builder. Okay. So, what are those advantages? What does it look like, guys? Okay. Number one, you're going to always have downside protection built into the portfolio. If World War III breaks out overnight, stock S&P 500 goes limit down 20% the next day, you're going to have a huge smile on your face financially anyways, because your capital is just skyrocketed up because of your hedge. Okay. Now, there's going to be worse problems in the world, but financially, you're going to be really happy. Okay. Number two, you will always have control of your capital and you can liquidate when needed without early withdrawal fees. Okay. Number three, you can learn everything we have over the past 3 decades, then relay this to family for a multi-generational impact. All advisors and funds keep you uninformed and frankly, want it that way. Number four, we have a flat fee that won't grow when your account does. Okay. Number five, we're going to have live interaction with your chief investment officer. And this won't be found with any other firm in finance, period, folks. Okay. You're going to be able to interact with Jason as much as you like in the live webinars. And it's a really cool way to learn. Okay. Number six, you're going to get in and out of positions faster than the big funds. There's safety and ROI advantages that will keep you safer and add gains by working with us, guys. Look, these huge mutual funds, these huge hedge funds, it takes them literally, guys, weeks to readjust, right, and make changes as the central banks make changes, or as the market changes, macro events change in the world. Okay, guess what? When you work with us, when you buy and sell a position, it's going to take you seconds. Okay, so we're going to have advantages over the big guys because of that. All right. So investors, we have a holiday discount offer that is limited in time. Stay tuned to see the savings that you can take advantage of today. Just important note, guys, there is only 3 spots per portfolio per day. Okay. With that, Jason, I'm going to hand it over to you, bud.
Okay, excellent. Wonderful, guys. So let's talk about how we can achieve the 25% per year target safely and do it without being a fool. Okay, so a lot of products out there that you've likely been exposed to are going to ask you to essentially invest in some pretty risky companies that have low liquidity, and perhaps the advisor is actually front running you himself, which is sad, but that's happening all the time. What we're going to teach you today is really the opposite. Instead of buying these hardly known, illiquid, dangerous stocks, what if we change the plan and just buy the biggest, baddest companies on the planet who are owned by the richest people on the planet, and then hedge and sit back and watch the profits pile in? Okay, what if that was how simple this really could be, and that you're going to be watching this grow without doing anything, very few modifications, only make trades when it's critical, and watch your portfolio just climb higher and higher and higher. So Dean built that portfolio that he just demoed. And now, Dean, how many trades have you had to do to watch that thing grow so quickly?
0.
0. Okay, 0. Now, that doesn't mean we're not going to place trades, but it just shows you the power of buying the right asset, sitting back, and letting the markets do its job. So let's talk about this. What if we told you the best investment for the next decade would be essentially a basket of stocks that consist of Apple, Microsoft, Amazon, Facebook, Google, which is called Alphabet, Tesla, NVIDIA, Comcast, PayPal. That's going to be your top 10 positions representing half your portfolio, 55%. And then after that, you get another 95 stocks thrown in. Okay, but they're going to be tiny positions. And what's even better is these companies grow and shrink in size in terms of their profits and revenues. Guess what? Your portfolio is going to automatically rebalance. So as companies get bigger, you're going to own more of that company automatically. If they start to falter, your ETF is going to dump that stock. And what's critical is you never have to do a trade, realize a gain, and pay any taxes. And also, guess what? They have constant inflows of new funds. meaning they never have to sell either. They can just simply buy into the positions that are light to keep their portfolio balanced. So it's a beautiful setup. And the ETF that's going to deliver those stocks is called the QQQ. Now, we're going to actually look at a better investment than just the QQQ. But I just want to point it out. Look at this. If you had bought the NASDAQ over the last 2 decades, predicting that technology would grow exponentially, then you actually turned every $1,000 into $11,000 over 2 decades. And that's with holding through the 2009, 2008 housing crisis. In fact, the worst thing you could have done ever is sell. And I want to point this out because I look at today as basically being exactly right here, right around here in the markets. Okay, we had a crisis which created a sell-off just recently in March, as you all know. Now, the crisis wasn't that bad in 2008. They let it take about a year before they got their act together and started doing what's called quantitative easing. But the split second that this was even announced, it didn't even hit the banking system. Just the split second that confidence was rebuilt by announcing $1 trillion stimulus package coming through, guess what happened? Stock market ripped higher. Okay. And then this is what I would say you're at right now. You're somewhere right around here. You're at a new high and you're worried, is this the best time to invest in the NASDAQ? And the smart decision was yes. We're gonna understand really why in a minute here. But I just want to point out, if you were worried that the NASDAQ was trading kind of high, looks like the chart looks like it was expensive, it was over any moving average. Well, guess what? You would have said that same thing for all of 2011, almost all of 2012. You can see there's very few even red moments on our chart here where we're going beneath the moving average. 2012 just ripped higher. 2013 and 14, it was above its moving average the entire 2-year period. You never had a split second to get it at a discount. 2014 is just screaming higher. Okay, 2015 is when China nearly went bust. But here's the secret, guys. As long as there's low inflation on this core inflation data, which has nothing to do with what we actually buy in our real life, I'll show you that in a minute, you can really predict one thing. Anytime there's a slowdown in the economy, the governments are going to come in and pump more money and print more money and inflate financial assets back up. And they're going to just continue to do this until they break the financial system itself. So look at this, 2015, we got a little bit of a drawdown, but guess what? China came in with bazookas of stimulus to fix their economy, which is the growth engine of the world. And yeah, we got a little bit of a flat year, but then boom, markets are ripping higher into 2016, 2017. Now, 2018 was a little funny. We actually tried to do quantitative tightening because the Fed was so confident with all the tax cuts and deregulations and everything that was driving markets higher then, that they actually did quantitative tightening. And guess what? That created a bit of a sell-off. Started off with Bitcoin getting crushed in the beginning of 2018, then emerging markets. And eventually, by the very end of the year, with interest rates rising rapidly, we got a bit of a sell-off from October through December. But then what happened? Oh boy, the Fed reversed everything. It went back into QE. They called it repo and they claimed it was not QE. It was QE. And they started cutting interest rates and the markets just continue to go higher and higher. Now we got a bit of a panic in March, as you know. But then what happened? The government rushed out with $3.5 trillion CARES Act. Okay, and it took care of all their crony buddies. Got a few of us a $1,200 check, but other than that, it was basically just a huge bailout to the super rich who did what? They took the $3.5 trillion, handed it out to all their buddies, and they all went and rushed out and bought stocks because they know how this little game works of theirs. And now we're back to new highs. So if you have the mindset that stocks look expensive, you're going to just say that for the rest of your life and miss out on this trend. So this is the boring NASDAQ play with the QQQ. It's outperformed every hedge fund that exists, and it's with a single trade. Okay, there's no hedge fund that's performed like this. These passive index funds are really where the money's at. And that's why we're seeing mutual funds and hedge funds collapse. Normal folks can simply buy an index, sit back, and outperform everyone. Okay, now the power of compounding is great when you own the best companies in the world. But if you can triple your investment into that same group of stocks for free, let's take a look at what can happen with that. So this is the triple Q. This is going to be our core investment for our portfolio. And believe it or not, this was trading at $1.75 when they first put the product out. And again, the goal is to give you 3 times the return of the QQQ on a daily basis. Now, that doesn't mean you're going to make 3 times the return because this is going to hyper compound. You're about to see you're going to make far more than 3 times the return if you simply buy and hold the triple Q. So look at this. It's gone from $1.75. Okay, then it's up to $5.50 shortly after. Now it's up to 15. Okay, we're coming up. Now it's trading at 16, 24, 55. Okay, get a little bit of volatility. 77, 173. Okay, now let's just see what that is on a return basis. If we zoom out, that's a 9,241% return to date with a single position. Okay, and we're not asking you to buy some sort of risky small cap stock. These are the largest tech giants on the planet. So my job now is to help you understand why are these going up so quickly and give you confidence as to whether or not this will repeat in the coming decade. And I'm going to actually argue that not only is it going to repeat in the coming decade, it's going to outperform. Okay, and my goal is to actually have you completely understand why that's the case and why the US government's trapped into forcing this to happen. So if you put $1,000 into the triple Q instead of the QQQ, we could have cut your investment time frame in half. So instead of 20 years to hit 1,000% gain, we're going to cut that in half to 10-year hold and deliver a 9,000% return. So it's about, if you think about it, if you cut the time in half and then get 9 times the return, that's 18 times the return with the same amount of money in the market. It's just amazing. That means you could put 1/18 the capital behind this and get the same return as the QQQ. What would you rather do? Put all your money in the QQQ or put a lot less into the triple Q and make the same return? I think all of us would rather make 18 times our money. Okay, so once again, this is the basket of stocks that primarily are held in the triple Q. They're going to give you 3 times the exposure to these companies. So if you already own these, that's nice. But wouldn't you rather own 3 times as many? I'm sure you would. Now, one last thing before we jump into what's causing this wild stock market bubble to continue. Who are the richest people in the planet? Okay, we got Jeff Bezos with Amazon, Bill Gates with Microsoft, Mark Zuckerberg with Facebook, Berkshire Hathaway with Warren Buffett. But guess what? He's all in on Apple practically. Out of a $120 billion equity portfolio, 80 of it is in Apple, 20 of it, which we call growth, 20 of it's in Bank of America, which we call value or an inflation play. So right there off the bat, 90% of his assets are in 2 companies, one of which is your core position. After that, we get Tesla with Elon Musk, who sold PayPal, of course. So he's got 2 companies in our top 10. And then after that, it really falls off a cliff. Okay, so that's the strategy we're going to really be recommending today, is to buy the biggest, baddest companies owned by the richest people on the planet, and then to hedge accordingly. I'm about to show you how to hedge so that you can take out all the volatility in the market and safely buy and hold the triple Q. But first, we need to understand why on earth is this thing going up so quickly? And what if I told you Apple was able to double its stock price over a year, but its revenues only grew 2%? How is that humanly possible? We're about to show you. And I don't think many of you really have a clue what's actually making stocks go up. What if I told you the stock market goes up because the US government is exponentially growing its debt, and that the debt it creates is forming new money, which is essentially diluting the value of the dollar and making the cost of everything under the sun rise? And that stocks simply rise faster than everything else because of one other phenomenon called stock buybacks. So as long as we can predict that the government is going to continue spending money it doesn't have at the same pace or faster, we can easily predict that stocks will not just go up, they're going to go up even faster and faster as time progresses. This is October. We collected $238 billion in taxes, yet we went out to spend $522 billion. That's a $300 billion deficit. We're short by $300 billion. I'm rounding up slightly, but think about that. We ran a $3.1 trillion deficit in 2020. We're likely going to run $3.5 trillion next year. Now, I don't care whether you're Republican or Democrat, these elected leaders have managed to double the national debt every decade like clockwork, regardless of who's in power. And when we actually look at what the US government's promised its populace, the liabilities into the future are over $100 trillion. And as the population grows, as our debt grows, as our economy continues to falter, guess what's happening? The government's getting the ammunition it needs to print money faster and faster and faster. So what this really means is because the economy has been hit hard this year, the probabilities of the government spending more and more money are practically at 100% odds. There's very little chance the US government's going to suddenly balance its budget, not make good on its promises. Those leaders would not be elected. Okay, so that's what we really got to focus on is the debt is going to not just grow, it's going to grow exponentially. And the only way this happens is by issuing debt products. Okay, so this is the US Treasury market. It includes bills, notes, and bonds. This is where the money is formed. We create these debt products. Now, in really good times, where the stock market probably wouldn't perform very well, we can actually sell all these debts to other countries and not have to dilute the dollar. In bad times, that's not the case. And it's funny that we're going to actually believe the worse the economy is, the better the stock market's going to perform. So who's buying all this debt? Guess what? Nobody is. Here's what's happening. Primary dealers have to buy all the debt, and they do it with a great big smile. They get to borrow from the Fed for 0% rates. Then they come and buy positive yielding debt products, in which they then go sell these to anybody who's willing to buy them. So there's some foreign governments who like to buy our debt, but that's slowing down because guess what? They're having to do the same issue. They're having to create massive debt themselves. So there's just too much debt being created right now worldwide. So JP Morgan buys up all the debt by law. They have to. They get to borrow for free, buy up these products, which have a positive yield. So they're doing very well to start. They're going to go sell this to central banks around the world, to pension funds, to big broker dealers, to hedge funds. Okay. After that, what happens next? Well, whatever's unwanted, whatever they can't sell into the market, guess what? They get to sell it right back to the Fed for a huge profit, massive profits. And this is what grows the money supply. So if you thought the last return on the stock market over the previous decade or post the housing crisis was great, realize it only took $1 trillion in QE to start off, another $1 trillion by 2011, and another $2 trillion by 2015. Over the course of about 6 years, they printed $3.5 trillion. Guess what they've done in the last 6 months? They've printed $3.5 trillion. They're actually printing money right now at 10 times the pace of the previous crisis. That's mind-boggling. It's absolutely mind-boggling. So what's happening to the value of the dollar during periods like this? Well, It's not even just periods like this. This is a 100-year chart of the purchasing power of the dollar. Outside of the Great Depression, when we're on a gold standard, the value of the dollar has been crushed 98%. Okay, so that's what's really happening. Stocks are going up because the value of the dollar is crashing. It's not just the dollar, it's every fiat currency in the world. And that's why everything in your world is going up in price rapidly. So we could look at rent. This has gone from a 103 reading on the CPI index to 350. Okay, that's a 350% increase in cost. If we look at medical costs, that's up 550%. Okay, college is up 1,600%. Has the income from a college degree rose 16 times? I think not. Electricity since the 70s is up 1,000%. Okay, it's just absolutely insanity. And when we look at the real inflation rates based on what we actually buy since the 1980s, and this is again the old CPI model, you can see inflation's not just high, it's in an uptrend, it's going far higher. And basically, if you have $100,000 today, in a year, you're going to have $90,000 worth of purchasing power. Wait another year, it'll be down to 80. If you wait 5 years, it'll be cut in half. And that's being relatively generous with how fast the dollar and other fiat currencies are declining. Just pull up a chart of Bitcoin to get a real feeling for how fast the value of fiat is falling compared to other assets. So if you think about it, for every penny that's been created over a 100-year period since the Federal Reserve's been around, we just diluted the value of the dollar by 40% in 6 months. Now, it takes time for this money to start getting circulated, for people to start realizing that the value of each dollar has been diluted, for everyone to start raising prices, which creates a domino effect. But believe this, the value of your money will fall, period, if you stay in cash. There's no way around it. Okay, the government is not going to stop spending money it doesn't have. The only way they get away with this is by issuing debt, and they've created a highly profitable circle jerk between the Federal Reserve and basically JP Morgan, where they get to make billions of dollars doing this. They borrow from the Fed for free. They buy up all of our debt. They sell it to whoever's dumb enough to buy it. And then whatever's left over, they dump back to the Fed for even more profits. And this, my friends, is the creation of money. This is the core reason why the price of everything on the planet and the whole universe goes up. You dilute the dollar, and the cost of everything else will rise. Period. End of story. Now, there's one more phenomenon that makes this even more attractive. How did Apple go up 100% by growing its revenues 2%? Well, first off, the dollar has been crashing. That's the most important thing to get through. But on top of that, Apple has so much money that they don't know what to do with that they've decided to buy back their own stock. So there's actually less stock over time as there's more dollars. So this is creating an absolute frenzy to buy and control the limited supply, not just limited, the shrinking supply of stocks that represent the profits of the most profitable companies in the world, which we now have on the screen in the tech sector. Okay, so this phenomenon is not going to change, not anytime soon. So if you think stocks are high now, wait for a year when we've pumped another $3.5 trillion of debt through the system and devalued the currency even further. Okay, this is an unstoppable trend. Now, these are a great play. This is where we get most of our capital. We have a few other plays for you. The first play is we want to actually buy insurance so that we can remove volatility and actually increase performance over time. So if you're worried about stocks selling off, first of all, you shouldn't be. If we look a year or two from now, we can accurately predict the government will spend most likely $3 to $4 trillion it doesn't have in the coming year, and it's probably going to only be able to dump at most half of that to foreign investors. So I'd anticipate the Fed's balance sheet will grow by $1.5 to $3 trillion next year, which is going to be absolute steroids for stocks. But can there be rare times where people freak out and sell? Yes. As long as we're dealing with the ability to continue devaluing the dollar, though, that's a buying opportunity. That's a buy the dip, a rare buy the dip. And so here's the plan, guys. We want to have what's called the VIX, protecting our long position, because anytime stocks go down, the VIX skyrockets higher at a faster rate. That means you can have a small VIX position, and if stocks have a violent crash, you're actually going to net a profit. We're going to cash out your crash insurance, and guess what you're going to do with that? You're going to realize that the government's going to react to any volatility in stocks with massive spending, which will pump the market right back up even faster. And so you're going to be buying while everyone else is freaking out selling. You're not going to sell your position because we don't want to realize a gain. That's stupid. All we want to do is cash out the insurance and buy more stock. We want to be greedy when everyone is fearful. And the secret to that is to always have this crash insurance in place. So now in the past, playing the VIX was really an advanced strategy. Today, it's so easy. There's an ETF called UVXY, which is an absolute dream come true for anyone who owns stocks. My 11-year-old even has insurance on his portfolio that's hyper aggressive. Okay, so if an 11-year-old's smart enough to get crash insurance, why don't you have crash insurance in your portfolio? Because it's been too hard. You had to be an expert at trading futures and options to do it in the past. Today, that's not the case. Today, we can buy UVXY and sit back and let it do its job. Now, in March, this was trading just around 11 bucks. Okay, you didn't need to predict the world was going to lock down and go into this insanity. All you had to do was own the insurance, just like you're a good boy who owns car insurance, you own health insurance, you own life insurance. Okay, do you own stock crash insurance to protect your retirement? If you don't, this is the single most important thing you should take away from today's presentation, is that UVXY will provide extreme protection against any kind of volatility in the market. Okay, so just right now, our clients who have that hedge in place are up 6% on this play. But look at this. The UVXY went from 11 bucks to 135. Okay, so if you had a 10% position in UVXY and the rest of your positions went to zero, just for fun, let's just say that, you netted a 30% gain in a month. Think about that. While everybody else is freaking out, you'd be up. You'd be making a profit. And then you cash it out and buy more stock. It's just a beautiful way to hedge. So again, if we put the percent change on this, we can see this rose by almost 1,200%. Just a mind-blowing return here. Okay, so that's your second position. And again, this is what it really looks like. Our long-term hold is the tech giants who are going to keep dominating, monopolizing, buying back their own stock. If there's any kind of panic for any reason under the sun, we don't really care what it is. We don't care because we have insurance at all times. Now, at a minimum, we're going to run a 10% position in UVXY. If we think there's a chance of a sell-off, we'll double or triple that. Okay, so again, this is the program who's going to try to make you a lot of money in the rare times there's sell-offs. But most of the time, we're just letting it set and slowly melt up every single day. That's what you're going to see most of the time. Okay, so if that's all you did with your portfolio, you would do just fine. We want to add two other plays to it to help increase performance, though. So the next play we're going to recommend to you is silver. Absolutely, silver is about to repeat what it did in 2009 through 2011. But probably, again, it could most likely outperform it 2 or 3 times. Now, if we look at the size of QE today compared to the previous round, we just told you it's 10 times the QE right now. I'm not sure we'll get 10 times return on silver, but at least double. So silver did outperform stocks early on in the early recovery years, 5 to 1 compared to stocks. So it makes sense to have about a 10% position in silver. We like AGQ because it's going to take every $1,000 you put into silver and it's going to give you $2,000 worth of silver practically for free. So again, when we realize our money is trash, we want to get leverage. We want to borrow. If the Fed's going to put interest rates at zero and do QE, that's the Fed telling you, you need to borrow as much money as you can and invest it and sit back because they're creating a market melt up. So yeah, every product we have does that for you. We're going to get free money from these ETFs so that we can double and triple your exposure in the markets and hyper compound profits much quicker. So AGQ is our silver play. This is really a bet that inflation is going to come back, but the bond market's going to be suppressed by the Fed with QE. And that's almost guaranteed to happen. And I think it's going to start happening aggressively in February as we reopen the economy. Okay, one last play. This is what we got investors in right around here early on in November when we saw that the vaccines were coming out. So your portfolio, this is a breakdown of the S&P 500. Your portfolio is basically the top performers up top right here in this line, which we call growth. And then we're going to have you into the best oil companies, Chevron and ExxonMobil. Maybe not the best. Let's just say the biggest with the most market share. And ever since we got into that, this has been outperforming everything under the sun. And that's because it was sold off so dramatically. In fact, remember when oil went negative for a short minute this year? So these companies are just going to scream higher as the price of oil rises. Again, because we've diluted currencies worldwide. So those are the 4 ETFs we're going to be getting you invested into. But really quickly, I want to point out it's not just the United States doing QE. In Europe, they printed $2 trillion so far. They're on track to do another 1.5 next year. Japan did a quick $1 trillion pump this year. China is growing their M2 supply, but for China, you really want to look at their credit. They have what's called a shadow banking, and they value their banking sector at $43 trillion, twice the US's, which is insane. But you can see they are pumping money into their economy at the fastest pace in the last decade.
Yeah.
So when you look around the world, everybody's doing the same thing. They're in a currency war. They're devaluing their currency. They're pushing money into the broken parts of their economy, and they're trying to recover the labor force. So until that labor force is red hot, they're going to keep doing this at a very aggressive rate. So yes, we're extremely bullish in this portfolio trading plan. So let's take a look at how it works with our product. This is a look at our trading plan. And again, this is updated daily and sent out to our clients with 3 live premium webinars every Monday, Wednesday, Friday. This is your free trial webinar. We're going to get you into the plan right now. We're about to start building out trading plans live because we believe money talks and everything else is just noise. So let's make you some money, and then you're going to become a lifelong client. How does that sound? The pitch ends here. It's time to put what you've just learned to practice. So let's talk about how you'd follow the trading plan right now with as little as $1,080. Okay, so here's what you want to pay attention. In column A, you get your ticker. Column E, you get the number of shares. Okay, everything else you can ignore. What this is telling you is if you wanted to follow the trading plan today, you'd be picking up 9 shares of UVXY, 4 shares of the triple Q, 2 shares of AGQ, and 12 shares of ERX. Now, let's say you had $10,000 you want to put in the market. And in fact, we want to do even units. 1 unit costs $1,080. So I've done $10,820. Well, this prints out exactly what to do. And again, we're about to do this for you guys live. You're going to tell me how much you want to put in the market. We're going to calculate this out and email it to you. But in this example, I'd be doing 90 shares of UVXY, 40 shares of the triple Q, 20 shares of AGQ, and 120 shares of ERX. So again, you have growth, you have crash insurance or the deflation hedge, You have the QE hedge with silver, and then you have the inflation hedge, which is from rising oil. That's the primary driver of inflation in the economy, which really benefits ERX. Okay, so this is a beautiful portfolio. About 64% of your assets currently are held in the growth sector, approximately 10% in your deflation hedge, 10% in your silver QE hedge, and just under 20% in your oil inflation hedge. Okay, it's a beautiful setup. Now, if there's anything to do, you're going to get a trade alert. And I do have 2 critical trades coming to this portfolio in the very near future, especially if they pass this stimulus package, which could be happening in the next day or two, which is $1 trillion stimulus that could make this portfolio absolutely melt up in the next 10 days. Okay, so the next 10 days could be very exciting for investors holding this exact setup here. Okay, very good, Dean. Let's go ahead and put our poll out.
Okay, perfect.
And take some questions and build some portfolios live. So what we do now, guys, is we build your portfolio live.
Yep, and just take a few seconds here, folks, to fill out the poll. There's going to be 2 questions in it, okay? And the poll screen should have just popped into your computer or your phone. The first question is, investors, it's critically important to review how much cash the Federal Reserve is burning in your ecosystem. Let's seriously think about the cash that you have sitting in your brokerage/bank accounts today in this exercise, okay? And please select a response below. Okay, and you have the option to select less than 25,000 in cash, 25 to 50,000 in cash, 50 to 100, which I see a few people have selected already, 100 to 200,000, 200 to 500,000 in cash. Okay, 500 to $1 million, and $1 million to $5 million. And then also we want to get a good feel, folks, for why are you guys sitting in cash today, right? A lot of people honestly tell us they have no idea that that inflation is literally burning their cash at the fastest rate in U.S. history. 50% said so far, I'm looking for a safe place / portfolio system to invest with currently. Beautiful, guys. That's exactly the intention of our strategy. Okay, the next selection is I had big losses in 2000, 2008, and Q1 2020, just hesitant due to the big losses. After that, guys, have just fired a money manager / liquidated a mutual fund. I'm looking for a vehicle now. We did have 33% say that they just got control over a IRA / 401k and want to invest it safely. And no other respondents yet. And so far, we have 27% of the crowd that has responded. So thank you, folks, for whoever's filled out so far. Okay, now we have some more filling out. Beautiful. All right, guys, and awesome. The point of the webinar, guys, is to show you not only the assets that you want to own today, that you want to own for the rest of your life, what you want to own kind of on a shorter term basis as well. But really, guys, you know, a huge part of this for us is teaching you how dangerous cash is today. And it's awesome because 50% of the people that are in here really had no idea that inflation is burning their cash at the fastest rate in US history. So I love when I see that. That's part of the intention of the webinar. So beautiful, guys. Okay, cool. Now, I6 Vidi 2K19 asked if the UVXY is a featured ETF that can be traded in an IRA. Yes, I6 Vidi 2K19. That's a pretty crazy screen name. Who is your broker, I6? So, hey, I6, I see your mic is open. Merrill Lynch. Okay. Yeah, double check with them. You may need to fill out an approval form to trade it, but yeah. So typically, you may have to just fill out some form to be able to position into that. Okay. So yeah, make sure to check with them, I6. And then if you can, I6, if you can just type in your name too, just so I know who you are, that would be awesome. Because I have no idea from the screen name. Okay, and then TM, I see your hand is up, and Rude, your hand is up. So very cool, awesome. Thanks, Frank. Appreciate it, bud. Okay, great. And TM, go ahead with your question, bud. Your microphone is unmuted, and if you guys want to, just let Jason know, hey, you want to start with 100,000 or you want to start with 50,000, whatever that number is, guys. If you want to start with 5 million, just let us know. We'll get it built out for you. Okay. Very nice. And Oh, okay. So I see TM went ahead and put their hand down. Okay, and Rude, go ahead and ask your question there, bud. And whoever's first, feel free, guys, jump in there. Looks like 40% of the people have filled out the poll, so appreciate that, team. Okay, and our number one answer so far is people had no idea that their money is burning at the fastest rate in U.S. history. So very cool. Okay, yeah, TM, and we can walk you through everything here too. It's not too hard to get you caught up. But
Come here, Derek. I can't hear you. Hang on.
Oh, hey, Frank, how's it going? Hey, Frank, can you hear me okay, bud?
Hello?
Yeah. Hey, Frank, I can hear you loud and clear. Can you hear me okay?
Yeah, I'm sorry. I was just screaming, talking to my wife.
Okay, cool. Yeah, and Frank, how much do you want to, how much capital would you like to deploy today behind our safe alpha strategy?
Yeah. Hey, but before my ID license shipping, I need the pictures, okay?
I'm sorry, Frank, can you speak up?
Okay, sorry. I mean, I had a little interruption. It's okay. No problem.
Okay, yeah. And Frank, how much capital would you like to structure behind the portfolio today?
I was thinking between maybe 100
Okay.
to 150, something like that.
Okay, 100 to 1.
Right, you know.
Sure, absolutely. Okay, did you want to maybe kind of go in the middle and do 125?
Okay, that's fine. Sure.
Okay, cool. All right. So
Now,
Jason,
I think you're right. I might have to fill out some forms with Merrill Lynch because I tried to put an order in just to try it out.
right.
And this security is not currently available.
Huh. Okay. Yeah. Merrill Lynch, unfortunately, is one of the most and more restrictive brokers that are out there. Okay. Do you have another account with TD or Fidelity or Schwab?
I have one with TD Ameritrade. Maybe I should transfer some money there.
Yeah, and you can certainly get it built out as well, Frank, with TD instantly. Okay.
Yeah, I have a small account with TD Ameritrade, so
maybe you can also use TD Ameritrade for the UVXY and then do the other three in your existing portfolio. They don't need to be in the same account.
I see. Okay, I see what you mean. Yeah,
that'll make your life easier.
Yeah. Okay.
Great call, Jason. Yep.
Now, what we recommend there, Frank, is a lot of. Do you want to go all in, or do you want to leg in over 10 weeks?
Well, I was going to try gradually, right?
That's what we recommend. So I'm going to give you. This will cost This will cost $13,525 to build. It includes 113 shares of UVXY, 50 shares of the triple Q, 25 shares of AGQ, and 150 shares of ERX. And you would do this once a week over the next 10 weeks to get completely built in.
Oh, okay. I see.
Okay.
Okay. Maybe I should. Do I have to write that down?
I'm going to email it to you. So
okay, good. Thank you.
What I need you to do is post your phone number and email in the chat box.
Okay.
And then I will get this sent to you and add you to trade alerts. So if we get any trade alerts, you'll get an email and an SMS text message telling you exactly what to do. Okay.
Okay. Sounds great. Appreciate it. Thank you.
Yeah, you're welcome. All right. That's one portfolio built. Who is next, guys? Our goal is to get at least 10 portfolios built a day if we can. This makes us feel like we've done a good job really helping people out with their retirement. Okay, so Frank's good.
My name is Sean.
Hi, Sean.
Hey, I've got available right now $33,000 in cash. So we could maybe put that in for me.
Okay. So I'm going to do 3 units, which would be $3,240.
Okay.
So you're looking, and this is, a 10-week plan. So you'd want to do this exact setup every week for 10 weeks. We're looking at 27 shares of UVXY, 12 shares of the triple Q, 6 shares of AGQ, and 36 shares of ERX.
Okay.
Okay, I'm going to screenshot that and get it to you. If you could post your email and your phone number for trade alerts in the chat box, we'll get this out to you right now.
Okay, sure.
Excellent.
Thank you.
Yeah, our pleasure.
I have some questions, like how long have you guys been doing this and what has been the average return, let's say, over 2020? Did you do it in 2019?
Yeah, we launched in 2019. We did 25% return last year. This year, honestly, I was trying to catch a sell-off, so we gave up a little bit of our profit. So we're performing at about a third of our target this year.
Okay.
But again, we were positioned to make a massive return if we had a sell-off in November because of the election chaos. It didn't happen. So I do want to point out that even though we're a little bit behind our target this year, we were positioned to make a massive gain if there was volatility. And that's really important to investors. They want to know if there is a sell-off that we're going to make you a lot of money. And I can promise you that is the case. Okay.
Okay, I just sent my information there.
Okay, wonderful. Okay, Frank, I got your info. And Sean, I've got your info. That's 2 portfolios built.
Great.
And again, these emails will hit your inbox right after the webinar. I'm just putting them in a Word document currently, and then they come out to you shortly after that. See, Tim, would you like a portfolio shipped off to you? Okay, great. We got 2 portfolios built. Who would like to go next? You can post in the chat box any amount of capital. And what I'll do is break it into 10 increments and then ship this off to you.
Beautiful. And then Jason, Roy, let's see here. What's Roy's last name? Roy Jaron would like to do $100,000 build out as well. And I'm posting that into the chat box for you. Okay. Yeah, he posted to the Jivo chat instead of the Zoom chat. So Roy, and just real quick, bud, if you are in the Zoom and you may be on the live stream, I'm not sure. But if you are in the Zoom meeting, you can use the Zoom chat instead of the chat on our page. Okay, cool. Yep, awesome, cool. And we're getting you all built out too, right?
Okay, Roy, here comes yours next. So I put it in for $10,820. That'll do 10 clean units. And what we're going to do is invest in that once a week for 10 weeks.
Okay, cool. And then TM says, I need to know more about your system of investment, time frame, rate of return, and what type of investment. Yeah, great questions, TM. That's exactly what we're helping people understand today. All right. So our system of investment, it's called risk parity. It's what all the billionaires do, but no retail investors do. Okay. That's kind of easiest way to explain it. Long story short, you're going to get the best assets on the planet, long-term hedge that risk, and we'll also have shorter-term positions that will actually outperform our long-term holding over the short term. Okay. Now, time frame, we've made a change about every 5 weeks, TM, but not to say that that's going to be the case moving forward. Whenever the central banks change or macroeconomic events change, we will as well. Okay, and we'll send you a trade alert via text message and via email if you are one of our clients. Okay, and look forward to helping you. The other thing is, TM, we also, with the Safe Alpha portfolio that Jason's helping get built out here, we have live education Monday, Wednesdays, and Friday at 1:45 Eastern Standard Time. Okay, so we're going to go in and explain, what's going on with the portfolio, why we've just made over 10% in the last 3 weeks. in the webinars, right? And then look at the stuff that we're looking at to potentially switching into, okay, the assets, and really go into great detail explaining, what our thesis is and why. And then it's really neat because our clients will end up asking, probably 30, 40 minutes worth of questions in the client webinars. And it's really cool, guys. And if you ever need to, if you decide you want to allocate another 100,000 once you're comfortable after a month or two working with us, you can just, ask Jason live, hey, Jason, I want to put in another 100,000. What does that look like? He'll customize that for you. So it's really cool, guys. And we look forward to working with you. And great question, Tim. Appreciate it. And Safe Alpha is looking for a 25% rate of return over 2021. Okay. I think that's going to be pretty conservative, but hey, better to always undersell and over deliver. Great way to work with people for long periods of time. Okay. And thank you, TM, for those questions too. That was wonderful.
So Tim, we're playing the NASDAQ, which is Apple, Facebook, Google, all those big guys with the triple Q. That's your core position. We're playing precious metals with silver, spot silver specifically. That's our QE hedge, where you suppress bond yields while inflation recovers into next year from reopening the economy. We play the ultimate inflation hedge through oil and gas companies via ERX. And we hedge against downside risks with UVXY. So it's a very simple 4 ETF portfolio. Now, our recommendation is to take the total capital you want to put in the market, divide that by 10, and then leg into it over a period of 10 weeks. We want you to have a very smooth entry point and a very smooth first experience with our firm. And that's what we found is really the recipe to get a lifelong member. So by giving away the trading plan, we now have 1,000 members. That's how well this works. Okay. So, we could go on and on and on and on, but if you build the portfolio, you make money and you see how it's designed, that's what's creating lifelong members for our business. So in 2 years, we're up to 1,000 members, just to give you a feel for how successful this is in terms of actually making something that works. Isn't that a wild idea, an advisory that actually works?
Yeah, and it's so funny. I'm not kidding you, Jason. In the last 2 weeks, I've literally talked to 25 people that said that their advisor had basically averaged somewhere between 5 and 7% for the last 20 years.
Oh, it's because they're making it too complex. Yeah, they're making it too complex.
Yep.
Look how simple this is. Tim, tell me any number you want to try out with the program. I'll print it out and email it to you, and you can think it over, okay? I really want to get everybody a portfolio designed and sent over. Let's see, Rude, Lee, MG, Robert, we already built yesterday, so he's just tuning in again. Sean and JT, you guys are the ones we need to get your portfolios built, okay? So find your chat box, pick a number, any number. I will punch it into the calculator, screenshot it, send it over to you. And then you can consider whether or not this makes sense. And if you want, just jot down on paper the number of shares, the price, and then you can paper trade it too. Okay, Tim, so are you thinking about 20,000 total or 20,000 to begin? Because if you're saying 20,000 total, I will calculate that out into 10 investments, which would be, we're going to go to 1,080 times 2, which would get us at 2160. So this would be 2 units or 18 shares of UVXY, 8 shares of the triple Q, 4 shares of silver, AGQ. Okay, he wants to start off at 20. Okay, I'm going to go to 1,079 and multiply by 19. That's going to get us right at 20,501. Is that okay, or you want me to go below 20K with 18 units? If I go to 18 times 1,080, that's going to come at 1944. Okay, so this would build 19 units and keep you right under 20K. Okay, he's willing to go up to one more. All right. Yeah, it's a slightly over 1,000 to do 1 unit currently. Okay, so let's get us at 20,520. So you're looking at 171 shares of UVXY, 76 shares of the triple Q, 38 shares of AGQ, and 228 shares of ERX. And again, this portfolio it looks simple, but you got to realize this is a highly sophisticated strategy. We have 3 hedges guarding the main position, which is your growth stocks. Okay, once you figure out just how protected this is, I think you're going to really enjoy it. Okay, Tim, I need your phone number and email. There will not be marketing. What you get is a daily update with trades. So if we're going to make any trades, you're going to get a text message and an email. And in fact, if there's no trade, we also tell you there's no trade. That lets people know right away within the first hour of the market opening whether or not they have any work to do that day. And again, I do have 2 trades coming up, so you do want to get those updates. Namely, I want to short the junk bond market and the treasury market. I think they're going to be really hurting from rising interest rates and rising inflation next year, which should begin around February. Okay, great. I've got that, Tim. If you could provide a phone number, Tim, we can get you the trade alerts as well on the SMS. All right, while we're going, we've now got 4 portfolios built. Can we get another portfolio built? Again, guys, it's, I know it seems crazy that we're giving you the product for free, and we're so confident that after you've tried the product out, you're going to become a lifelong customer. Have you ever found an advisory this confident? I don't think so. I know that because me and Dean spent the last decade selling all their products. And guess what? None of them work. Spoiler alert, they all suck. Which is why we've taken Ray Dalio's portfolio. That's what this is, guys. This is not something I've invented. Why reinvent the wheel? We can look at the 13F filings of Buffett, Ray Dalio, Druckenmiller every quarter and mimic what they're doing in a very easy to follow strategy. And guess what? It outperforms everybody. And it's so easy. Regina, I see you have your mic unmuted. Can I answer a question or build you a portfolio? And Tim, I see your microphone's open. Would love to speak to you and say hi. Okay, Tim's asking what will be the return of a 20,000 investment over 10 weeks? You know what, Tim, here's my look at the market. I don't believe, and the best investors in the world don't believe this. They don't think they can predict what's going to happen in an hour or a day or a week. We're really looking 6 to 18 months down the road, and we're targeting a strategy that can perform at 25% a year. That's our minimum goal of return. Now, again, if I think there's a risk of losing money because of a stock sell-off, I'm going to play it safe. So I don't mind making a little less if I think there's a risk ahead and we need to protect capital against volatility. So yeah, we've got people trading with 10, 20, a million, 2 million. I think we got a few people in the 5 to 10 million range. And they expect one thing, protect capital first, and then 2, look for the easy hanging fruit. Where's the easiest, safest way to deliver gains to our clientele? But yeah, I think they're going to pass a stimulus deal and that the market's going to melt up. I wouldn't be surprised if we hit another 10 to 20% return in the coming weeks and months. Again, so, but again, I'm not going to tell you I have a magic crystal ball and I know it's going to happen in a day or 2 days. What I can do is tell you the big picture. And Tim, you're going to want to replay this webinar. So if you go to your email after this is over, wait about 5 minutes and then hit the button. I want you to rewatch the 1-hour presentation I gave you, which really explains why stocks go up and why we're very confident 6 months, 12 months, 18 months that we're going to make a massive return. I think 25% is going to be a lot less because we're in a massive, aggressive, quantitative easing period worldwide. So it's going to take something catastrophic for these not to melt up. And again, we have that UVXY. So we're really not worried about volatility in the short run because the long-term picture is market's going way higher, way higher.
How do I get out of this?
Yeah.
Okay, I see a few more people joining in here. Okay, guys, if you post your quantity of investment in the chat box, I can get your trade alert out. And again, we have a premium webinar in the evening. If you do decide to buy the premium membership, that's where I'm going to go into a lot more detail with our other paid clients. Right now, our goal is get you built, let you see it works, and then the rest comes easy. Then everybody wants to join the product and get the updates.
Beautiful, Jason. All right, so 6 build outs so far, looking good. Looks like that's about $500,000 in capital going in. Very beautiful. Okay, all right, guys, don't be shy. Jump in there and look, guys. If you want to paper trade this, you can certainly do that as well, right? But we're here to custom tailor your build out, and so look, if you want to put 100,000 on paper, or 20,000 on paper, or 500,000 on paper, just let us know what that amount is, guys, and we'll get it custom tailored for you.
And Tim, this is your core investment, Triple Q. It's returned 9,282% in just over 10 years. So if you put $100,000 into that, you're sitting on 9.2 million. So
Not too bad.
a hell of a product. Now the VIX is UVXY, and you can see when stocks go down, that goes up. That's your crash insurance. So if all you did was these two plays for the next 10, 20, 30 years, you're going to make a truckload of money. But there's two other plays, of course, that make a lot of sense, that help defend against other environments. Essentially, we're worried about rising rates and inflation next year. Because guess what? We just diluted the dollar 40% in 6 months. How sad. So yeah, you got to understand what's about to happen. The cost of everything on the planet is about to rise rapidly as we fix the economy. So groceries are going to go up, gas is going to go up, electricity is going to go up, medical costs are going to go up. I don't think anything's going to go down in cost. Not when we've diluted the dollar by 40% because of the central bank's massive debt monetization. And stocks buy back their own shares, so they go up even faster.
Yeah, the only thing that went down this year was travel. Everything went up, and food's up 23% year over year now, Jason.
Oh God,
23%.
And we haven't even got we haven't even got the economy circulating the capital yet. Wait till all the dollars that we printed are once those start ping-ponging around the economy, it's going to create lots of increases in prices very fast. Yeah, even toilet paper will be up, Tim says. Everything. Even used cars are up. What the hell? Why would used cars be up when we're all locked down? They're almost at an all-time high right now. For heaven's sakes. So yeah, we got to invest in the markets. Now, Lee says, yet we're told there's no inflation. Yeah, we know that's BS, huh, Lee?
Yep, and good point, Lee.
No inflation, my ass.
Yeah, food's just up 23%, but don't worry about that, Lee.
Yeah, don't worry. Your Social Security will remain flat for the rest of your life, but we're going to make everything go up 10 to 20% a year. Thanks a lot, government. Lee, can I build you a portfolio?
Okay, cool. And Lee, go ahead and jump in there, bud. If you want to go ahead and unmute your microphone, please feel free to do so. And then that way you can just interact directly with Jason verbally. Jason, did we get Roy's portfolio built out too for the 100,000?
Yes, sir.
Okay, cool. Just wanted to make sure because it was a little bit of a hybrid. So
I got him in at $10,820 for 10 units over 10 weeks.
Perfect. Okay,
and all these will go out right after the webinar closes out, guys.
Yep. And just quick teaser too, guys. We're going to do an awesome combo today that'll get you the safe alpha and the boot camp combo together for $3,000 savings. Okay. So we will be we'll be sending you that specialty link too when we send out the build outs. Okay. And it's we're just going to run it today, guys. We're not going to run it next week, and we're going to actually end the holiday special next week as well. So take one of the 3 spots you can. Okay. Let's see here. No, Roy, you don't want to use options, bud. That'll defeat the purpose of compounding. You don't, you certainly don't want to limit your ownership of TQQQ in any way, shape, or form. So you don't want to buy any options.
Yep, it doesn't get easier
Yeah,
than
no,
this, guys.
nope, it kills your compounding effect, Roy. You never want to use options. Look, why would you want to, why would you want to lose the compounding effect? I mean, look at what it did over 11 years, right? You're not going to make the 9,700% over the next 11 years, right? If you have to keep exiting positions, and it kills the compound rate. So do what Buffett does, right? Get the best assets on the planet, hedge your risk, and let compounding do the work. Right. And look, guys, and I think this is so important. If you read all of Buffett's books and study every single interview like Jason and I have, look, you'll understand that literally he is always looking at a decade plus time frame. Okay. So when you do that, guys, I mean, look, this is the most successful investor in the world. He's not looking at a leap time frame, right? Which can be 2 years, maybe 3 years, right? On an index, possibly, maybe. I think the most I've ever seen one was like 2.5 years out. But look, he never even shortens his sight that far, right? So do what Buffett does, right? He's the most successful investor of all time, gets the best assets on the planet, hedges his risk. By the way, Buffett's over 50% Apple right now. And that's our largest allocation with the TQQQ ETF as well. And if so, if so, that's his largest position, guys. I mean, think of, Buffett had Coke as his largest position, in the 70s, right? So he recently picked up Apple. I don't know how many of you guys knew that, but he's only very recently picked up Apple in the past few years. Okay. So that should tell you something, right? He's looking for Apple and technology to run for decades, right? Not for a year or two, right? You guys got to get out of the non-billionaire mindset, right? Think like the billionaires. There's a reason why they got there. Okay. They're getting the best assets on the planet. They're leveraging into them. Okay. We're not using as much leverage as these guys are, but hey, we're using what we can at 3 to 1. And that's still really good. Okay. And, every 100K that goes into that team, over a span of 11 years, if you just do what the historical did, that's 9.7 million, 11 years later. It's actually 10 years, 10 years and 10 months. Technically, it's not even 11 years yet. That will be the case in February, but, not bad, not bad. Okay, cool. And Roy said, got it. And he says, he's typing something out right here. So we'll read his question in just a second. So beautiful, guys. Okay. All right. And Roy is actually in Lake Worth, Florida, which I'm going to be close to. Roy asked, when is the last time we rebalanced? Jason, do you remember the exact date off the top of your head? I think it was roughly 2 months ago.
Right around when we saw the vaccine data coming in, we got long oil.
We ERX was the last one we added to. Let me see. I can get you an exact date actually. So let me go to that account. Hold on one second. Yeah. So yeah, the ERX, right, was the newest position. So let me take a look. Okay. Okay. Sorry guys, I have 6 accounts up here and running. Okay. Let me see where that is. All right. And the time on ERX. So that was on 11/18. Okay. And great question, right? Yep. So over the past month, guys, we've not made a change since we picked up the ERX position, and we alerted it at I bought in so I know Jason alerted it kind of 13s, and then in the live webinar, guys, I bought it at $13.35. Okay, and we're looking for that thing to push into the 30s or 40s in 2021, and it's still, what is it, 15 right today, Jason? ERX. Yep, 15.34. Yep.
Yeah, that's trading at a 30-year low on those companies. They used to be the tycoons of America.
Okay, cool. Beautiful, Jason.
See, Taz just hopped in here. You have any questions we can do for you, Taz?
Beautiful. Okay, cool. Okay, sounds great, Roy. Yeah, I'm going to send you my number, Roy. And yeah, for anyone that needs my cell phone number, guys, if you have any questions after the webinar too, please feel free to give me a call. It's 505 322 7515. Thank you, Roy. Look forward to speaking later, bud. Pleasure meeting you over chat. I'll be in your neck of the woods next week too. Looking forward to some sunshine. It's going to be the longest time it's ever taken me to get to the beach in 1 year in my adult life. But thanks, pandemic. Thanks, China.
Oh. All right, Dean, well, I'm going to go ahead and hop out, get ready for the premium membership webinar in a minute here.
Okay, perfect.
Want to
Okay, guys.
thank everybody for joining us live.
Yep. Appreciate your time, folks. If you do have additional questions, give me a call or just send me a text, 505-322-7515. Thank you so much, team. Appreciate your time and attention. Look forward to working with you in the afternoon webinar once you get signed up. Yep. Thanks, Robert. Let's see here. Thanks. Thanks, Frank. Thanks for joining us, guys. Appreciate it. And Lee, I love your comments still. That was awesome. TM, thank you. JT, thank you. Taz, thank you for joining us. MG, thank you for joining us. Folks, have a wonderful day, and we will see you in the afternoon webinar.
Wonderful. Thanks, guys. See you back.